Alright, today I'm going to show you my top strategy. I'm really excited about sharing this with you because it doesn't take a lot of time to execute, and it's very powerful because it's really based on how the market works. So here we go. How do we actually make money using fundamentals and behaviors in FX? There's one simple formula. Imbalance plus sentiment shift equals profitable price move. If you think about it, every big move has been the result of an imbalance that builds up and then the market reprices due to a catalyst. So the reason why we need a sentiment shift in addition to an imbalance is because we intend to move with the market instead of losing money trying to guess the bottom or the top of the market. So how do we find an imbalance? I use something called the imbalance wheel. Basically, it's an expression of the 4 different elements of the market, and during good times when everything is in balance, each of these elements are in agreement with each other and with themselves. When one of them goes off track, a discrepancy or an imbalance develops, and that leaves room for us to profit. So today we're going to focus on price and other markets' behaviors. So the main idea is that currencies are correlated with other assets. The price movements in both currencies and these other markets are all about anticipations of global supply and demand. But for some reason, markets don't always price in the same anticipations. One market may rally and the other may stay in a range or go the other way. And when this happens, these discrepancies or these imbalances lead to opportunities. So that was imbalances. Now we go over how to identify sentiment shifts. I use 3 primary methods. Firstly, I watch for net currency futures positioning to change direction. This can easily be seen from COT reports. Next, I look for price to react opposite to what news events suggest. Lastly, I listen for shifts in the keywords and the tone used by the media. Let me show you the exact process I go through to make a trade. First, I look for potential opportunities. I do this by identifying an imbalance using the methods that I showed earlier. Then I stalk the pair and wait for a sentiment shift because I want to move with the market and not against it. It's not a good idea to fight the market or outsmart the market. You can still move with the market and make plenty of profits. Okay, number 3, I wait for an entry setup. I usually wait for a good catalyst or trigger to propel the market in one direction. It's usually a big price move and some kind of fundamental news event to accompany it. Then I finally enter by scaling in, and this is for entering with good risk management. I don't know if a big price move in my direction is the start of a new trend that I can ride, or is it just a fake move that will soon reverse. I don't know the answer to that question, so I put on a small position at first, and as price starts moving in my direction, I add more. So let's go to an example now. The example takes place on the 22nd of March 2009 with the Australian dollar. The imbalance that developed was that since the beginning of 2009, gold had rallied considerably while the Australian dollar simply range traded during the same time period. So then the sentiment shift was that there was a shift in focus from words like crisis in the media to economic recovery, and in particular, Ben Bernanke, the chairman of the U.S. Federal Reserve Bank, came out and stated in a conference that the recession could end as early as the beginning of the year. Now, this was a huge shift and caused price to react really quickly because the market was focused on the gloom and doom story and is focused on the crisis, and then all of a sudden Bernanke comes out and totally shifts the market's perception of the situation. So that was our sentiment shift and also the catalyst. The entry trigger was that the price made a strong weekly close of over 330 pips above the open, and that was well out of the latest range. So we look for price to really break out of the range to show that things are going to become more volatile again, and we can ride the beginning of a new trend. Okay, I want to show you this visually with some charts. Gold decreased dramatically from July 2008 during the credit crisis deleveraging period when all global assets sold off. And a strange thing happened. There was a turning point in November for gold, and it started rallying heavily. If we look at the Australian dollar, which is normally correlated to gold because of its fundamentals, we see that the Australian dollar also had this massive fall from July to October 2008, but it just range traded at these very low levels for a long time. So that was the imbalance right there. And suddenly there was a sentiment shift in March, and price starts to increase. If you can imagine this on a weekly chart, this would be one really big bullish candle right here and would signal our entry. So after the close of that week, the beginning of the next week, we issue a buy order here, and we wait for a week to see what happens, and price doesn't really go in our direction after that point. So we wait a little bit longer, and price starts moving up again. So after the second week, price has made a new high, and so we put in a new buy order. And we're okay with buying highs because we know we have a strong driving force behind us. We have the powerful forces of an imbalance unwinding and sentiment shift pointing upward. When we enter these trades, we set a stop loss proportional to the average true range. In this case, the day of the entry had an average true range of 168 pips. So we'd set a stop loss of about twice that much in order to give price plenty of room to move. And then we keep on watching price. It keeps going up, so we add in another long position here. And it goes down, so we'd be hesitant after the following week to put on any new positions. We just see what the market will do. And then the price starts to go up again. We enter another long position. And another as price keeps going up. Because remember, it's unwinding this huge imbalance that developed. Okay, price ranges a little bit for a week and then starts going up again. So we enter another buy position there. And price keeps going up. So after another week, we enter another long position here, another buy. So that's 7 buys so far on the way up. We're scaling in our position, starting with a small position here and keep adding on small positions. And then finally the market turns back and has a violent fall of about 400 pips here. And then it sort of ranges up here for a few weeks. So we set a trailing stop because we can't time the market. We don't know when the market's going to turn and by how much. So we just set a trailing stop to let it follow price as it goes up. So this trailing stop was hit after we reached these highs up here and price started reversing. So all these trailing stops were hit at the same time and stopped us out mostly for a profit. There were 7 trades here. Starting with the first one here, we had a nice profit of 900 pips. The second one resulted in 672 pips. Then 715 pips. Then 604 pips, and it gets smaller as we go up because we're getting closer to the top. This one was 290 pips. Then we have 146 pips, and the last one we bought too high and ended up losing some money. We lost 150 pips here. This was a total of over 3,000 pips in less than 3 months. And it just required some patience and identifying a really big imbalance to occur, and then moving with the market. Now this is just one of the strategies I use, and I actually have strategies where I enter the market more frequently and make more steady income type trades. But this is one of my favorite strategies, and I'm glad I was able to share this with you.